Good morning. The Houston multifamily market update for quarter four of 2025. And the headline is Houston's multifamily market is not collapsing, it's normalizing. And that's an important distinction. And in quarter four of 2025, Houston recorded its 12th straight quarter of positive absorption. And annual demand jumped significantly year over year. And that's not weakness, that's structural renter demand. But what about rents, you may be asking? Well, they've softened slightly, is the point. But why? That's a question that needs to get asked. And it's really because supply has been elevated and owners are competing and concessions are happening and rent growth isn't aggressive right now. And that's exactly what a transitioning market looks like. So let's take a look at what really matters. Demand is healthy, pricing power is limited, location and asset class now matter more than ever. When we're talking about Class A properties, those continue to see strong leasing, and lifestyle and migration demand is a real viable force. Workforce housing remains stable, but broad Houston multifamily headlines miss the point. This is really now a micro market game. So you have suburbs versus your urban core. And suburban corridors aligned with employment and infrastructure growth are outperforming. Areas near West Houston, Katy, Fulshire, and North Houston employment clusters are really holding steadier as far as occupancy goes. Whereas urban core properties still command rent premiums, but occupancy pressure is more visible there. So what does that mean in English? Investors need to be selective. So let's take a look at the supply outlook. And construction is still active, but deliveries are slowing compared to earlier peaks. And that's something we've been seeing on a lot of construction recently. And if absorption holds and deliveries taper in 2026, pricing power gradually stabilizes. And that's the window where disciplined buyers should be watching. So let's talk about capital markets reality right now. And this is no longer a momentum market, but it's an underwriting market. Flat rent assumptions, conservative leverage with strong debt yield is going to produce realistic exit caps. And in today's Houston multifamily market, structure beats speculation. So let's look at 2026 and the outlook. And again, Houston multifamily is not distressed, it's recalibrating. And recalibration creates opportunities for buyers who negotiate well, and for sponsors with liquidity, and for investors who focus on the right submarkets right now. Now, if you're evaluating a deal in Katy, Fulshire, or West Houston, or anywhere across the metro, really, let's run some real numbers and not worry about the headlines. I'm Bill Rapp with EXP Commercial, the Viking Enterprise Team. And if you want to evaluate an acquisition or even a refinance the right way, let's break down the math and have a conversation. My name is Bill Rapp. Please visit HoustonRealEstateBrokerage.com and figure out how to get a hold of me. Love to talk to you more. Take care.